Hi, everyone. I just wanted to quickly go over a couple of transactions that were missed a number of times by folks. I just kind of want to do a little refresher about accounts receivable, accounts payable, and talk about how you can kind of decipher what the book is talking about when you see the transactions listed. And what I've done here is I've gotten exercise 3.2, and I've typed in the two transactions I want to look at. October 7th, received cash on account from Randy Hill, a customer. There's an invoice number, but I've skipped it here because it doesn't really matter for this example. And paid on account to Miller Ideas, a creditor, and let me put in the amount here is $725. Okay, so what's happening here in both of these cases is that these transactions that occur on the 7th and the 15th are referring to previous transactions. And even though we don't know what those transactions are, the the transaction sentence here lets us know what's going on. And so if we want to look at this, we can look at, sort of like what's happening and what accounts are being affected. And as a reminder, we're doing dual entry accounting. So there will always have to be at least one debit, have to be at least one credit, and debits and credits will have to equal each other. So the first one here is we received cash on account from Randy Hill, a customer for $970. Now, like I said, this is going to refer to a transaction that we don't know what it is because the book doesn't tell us. So, what I'm going to do in this example is I'm going to make up that transaction and sort of show you the start to finish how that would go. So, in this case, we're receiving cash from Randy Hill. So, we know that Randy Hill is a customer of ours. We know that he paid on account for something and that it was in the sum of $970. So, what we can decipher from this, or what I can do as an example from this, is set up that original transaction so that maybe this will maybe make a little bit more sense when you see it. So, again, this is not in the homework. This is what I'm just making up. This is when, let's say, Randy Hill originally purchased whatever it was he purchased. We're going to say that it was just revenue. We'll call it fees earned. So, in this case, we'll say accounts receivable and fees earned. And in that case, they're both going to be $970. So in that case, for that transaction, let's just say we'll put October 1st here and we'll say Randy Hill purchased $970 worth of services. We don't even really need to know what our business does on account. So here, what we would see was that, okay, it was on account. So we know that he's going to owe us money because he purchased it on account. He's a customer of ours. He purchased $970 worth of services on account. So we're going to count that as accounts receivable because we're doing accrual accounting, which means that we count the our fees as earned when the transaction occurs and not when the actual cash is received. So we count this as accounts receivable fees earned. So now when we get down to the 7th, what we have now is just the transaction of Randy Hill paying off his debt to us. And so in that case, when we receive the cash on account from Randy Hill, what's happening is again, we're receiving cash. It says there right in the sentence for $970. And what we're going to do then is we're going to credit accounts receivable. And I'll tell you why. The reason why we're doing this is basically what we're recording is the fact that this customer no longer owes us money. So when we counted in the original transaction here that I made up, when we debited that $970, basically what we were doing is we recognized that we had earned those fees and that Randy Hill owed us $970. So we can think of that debit for the accounts receivable is our record of the fact that he owes us money. So then when it comes to the 7th and he pays that off, what we're going to do now is we're going to credit accounts receivable basically to wipe away his debt from our books, because accounts receivable is an asset, and assets, as we know, are debit normal. So again, back here on the first, we had an increase in that asset of accounts receivable for $970. Here, because he's paid off his debt, we want to wipe away that 970 from accounts receivable and put it into cash. Because if we don't, then we're saying we got cash, and we would also, if we didn't credit accounts receivable in this case, we would be saying that he still owed us $970. So in the case of uh, the first transaction from the homework, it is basically the record of a customer of ours paying us off. So we receive our cash, and so we debit it because it increases, and crediting accounts receivable because we're wiping away that person's debt. And similarly, for the 15th, here we have paid on account to Miller Ideas, a creditor for $725. So the key here is it shows that we paid on account. So we know it is a debt that we are paying, and it's to Miller Ideas, a creditor. So again, for the 15th here, I'm going to do an example. I'll go ahead and size 16. We'll make this 16 here. And I'll do the other entry. Again, this is the other one that I'm making up that will go with the transaction from October 15th. So I'm just do another one from the first. I will increase the font on this. Thought it was. There we go. So October 1st, let's just say purchased, let's just say supplies, because that's a pretty easy one to do. Purchase supplies on account from Miller Ideas, $725. Again, this is one I'm making up just to set up the transaction on the 15th. So in this case, it's sort of the flip side of that first transaction. So in this case, we're going to have supplies, because that's what we got in this case. We purchased supplies, so our supplies account, which is an asset, goes up. And because it is debit normal, of course, we put it on the left side. And here, we're going to do accounts payable also for $725. Because in this case, our liability, our debt is going up $725 because we purchased it on account. So basically what we're doing here is not only recognizing that we got the supplies, but we're recognizing that we incurred a debt doing so. Because if it had been cash, we would just write cash, right? And then that would be the end of the transaction. But now what happens on the 15th is us paying off that account. So in this case, what we're going to do is we're going to record the fact that our cash is going out and that our debt is going down. Because again, we have that record of debt with our credit on accounts payable from the first. Now we want to wipe that debt away because we've just paid it off. In that case, so we'll go here and we'll do accounts payable for $725. And because we're paying cash to pay off our debt, we're going to credit cash again for $725. Notice here that both from the 7th and the 15th, we don't reference our fees earned, and we don't reference the supplies on the 15th. That's because those parts of the accounting have already occurred. We've already recorded that we bought those supplies. That part is done. What's happening on the 15th is simply a record of us paying off the debt that we got from buying the supplies in the first place in this example. And on the 7th, we're just, we're not referencing the fact that we made some money off of Randy Hill because we already have that fees earned recorded. What we're doing here on the 7th is just recording that he's paying off his debt. And again, those are a couple of fairly common errors. Some things to remind people of: always make sure that you have your debits and your credits lined up in this way, where the debit is flush against the side, and then you credit you indent for your credit. And if you have more than one credit, those credits will line up. you have more than one debit, those debits will line up. You want to make sure you get those in there. You also want to make sure that you're using the exact name of the account if it's given. Like for this example here, it just says receipt purchased, worth of services on account. We kind of had to make up our own account names. But when we get to the problems that do have a chart of accounts, you want to always use that exact name. You can't just use expenses. You need to use like gas and oil expense. I wasn't super hard about it this time as far as the grading goes, but we'll be going forward. Okay, as always, if you have any questions at all, please let me know. Come by the Zoom lab, the mediated lab, or send me a message on Canvas. I'm happy to go over any problems with you that you're having. Okay, that's it. Happy accounting.